Yo, what is up for everyone watching this on the YouTube replay? I hope you were having a great Monday because the market is absolutely having a great Monday. Let me give you a quick portfolio update because this is kind of crazy. If we head over here to our Moomoo portfolio, which is known as our buy and never sell portfolio, we were up over 4% on the day. We're up over $1,000, mainly just from Comfort Systems right here. Our main HVAC play, they're up 6.2%. Coca-Cola Consolidated, it's close to an all-time high. Powell Industries, how are they up today? Powell Industries is up 6.7. Well, that's after it's had this massive little downtrend. Amphenol is also doing pretty good. Actually, it's having a great day. Amphenol's up 4.6. We bought a share at 135. It fell a little bit, but looks like it's doing pretty good now. So Amphenol is one I am looking to buy more on the dip. But yeah, here's our Weebull portfolio, which is like our risk-on portfolio. We're doing pretty great today. I mean, not all time. If we go to our open profit and loss all time, we're only up 10% all time. But on the day here, we're up 2.35%. This is pretty crazy. Let's see what's up the most on the day here. So looks like AMD, Futu, wow, SoFi is up 7, Dave is up 5, Robinhood 6, Reddit 4. So here in our risk on portfolio, looks like a lot of names are up. Of course, the only name that's down is Sprouts Farmers Market. But yeah, and then we finally have our Robinhood portfolio. It's doing great. We're up 2.5% on the day, mainly just from Google. I can't believe it. Google won some like NATO contract. Their Gemini Pro 3 is like replaced OpenAI. I mean, Google is just a massive company. How much are, it's over a $6,000 position for me. In all time, we're up 95%. The only stock we're down on is Carlisle. I am actually looking to buy more shares of Carlisle on the dip. They're really interest rate sensitive. It seems like the mid caps that aren't interest rate sensitive are going up. Like, of course, McDonald's is down. And then we also have a Roth IRA. A Roth IRA is just a tax-free retirement account. And it's actually doing pretty good. We're also up 2.5% in this portfolio. Looks like Innodata is up 10. Yo, what up, Eric gang? What's up, Eric? What up, Looney? What up, Suzuki man? Good to see you. I hope you're having a great Monday because you must be with how green the market is. Let me actually check the watch list real quick. If we go to all of our stocks here, hopefully I didn't just unplug my mic. Okay. Actually, none of these stocks I really know. Wow, Broadcom is up 10%. I wonder why. I think that might have been a partnership with Google. I don't remember. CommScope is up 7. Yeah, SoFi. Anyway, let's look at some of y'all's stocks here. Someone said Fiserve. Yo, Fiserve, I feel bad if you own this stock right here because it honestly, sadly deserves to. Oh, they changed their ticker symbol. It used to be FI, and now it's FISV. Is that I could have, they must have changed their ticker symbol because I could have sworn the ticker symbol was FI. But anywho, they gapped down. They must have had such bad earnings they had to change their ticker symbol. Wow. Okay, so here's Fiserve right here. They do like over 40,000 transactions a day for businesses. And to be honest with you, sadly, after we've looked at this one, it honestly probably deserves to be at this 9.4 PE. So after this dip, they trade at basically 10 times net income. They probably deserve that current valuation, sadly. But the risk reward might start to look decent. But if we look at what the analysts expected versus what they reported, like this is the reason they had such a massive decline on earnings. Check this out right here. The analysts expected 5.35. They reported 4.9, so the huge miss on revenue, a massive miss on EPS, which is net income. The net income was expected 209, they did 140, and the EBIT as well is a triple miss, like not by like a little, but like a huge 30% miss on every metric. So something happened here. The growth is gone now, but here's the good news. They're still making 800 mil of net income a quarter. I don't know what it's going to be in the future, but to be honest with you, maybe a company with that kind of slowing growth and that kind of miss might deserve around a 10 PE. But honestly, the risk reward might start to look decent on this one. I don't know, but I don't know. Pfizer's bank operations. Okay, here's like what the bulls say. What did the bears say? Their bank technology business is very stable, characterized by high amounts of recurring revenue and long-term contracts. Okay. So let's see here. Do you know any Thanksgiving themed stocks? Not really. Elf Beauty. I actually don't know. We have 3%. Let's go Google. Hey, awesome JVM. Yeah, Google. I'm so glad I bought them, and I'm so glad I've never trimmed them or sold them before today. I don't recommend anyone trim or sell Google right now. I think they're just going to continue to go higher because they're just a beast. Literally in 3 months, Google's up 53%. It was already before. They're worth more than Microsoft now. Check this out. If we go to our mega caps right here, Nvidia is worth 4.43, and then Microsoft is worth 3.53. And then there's Google at 3.8. Google is almost coming for Apple now. Imagine Google being like over 4 trillion. That would be nuts. I mean, it actually already today is nuts because of this candlestick. But anyway, okay. Clorox. Hey, Clorox, this one unfortunately is not a good name. They own so many weird stuff. Like they own like a barbecue grill, they own Burt's Bees, they own Kingsford Charcoal, and of course all the sanitary products. So just like a discretionary item. But if we go to their revenue right here, this is why the stock is not doing too well. Why I'd be careful with this one. If we go to the sales of the company, the revenue is down at 19% year over year. So the sales are down 19, and then wow, the net income really fell 20% year over year. They only made 82 million net income. So something happened this most recent quarter. Gross margins fell 9, net margins fell. They have a bit of leverage and debt to pay. Yeah, actually the most leverage they've ever been since. Wow. So I'd be careful with Clorox. I think it's mainly like a dividend play. What's the dividend on this one? So yeah, basically 4.7% dividend. So you're mainly buying it for the dividend. I don't really expect this company to outperform the S&P 500 in the long run. I know this one was really popular during 2020 and COVID when everyone was buying disinfectant wipes and stuff, hand sanitizer. So, okay, my stock portfolio is red just because of I restructured in 2024. Rollover. Hey, nice. Hey, what up, two Katrinas? What up, Catherine? Good to see you. Hope you're having a great day. We must be with how good the market's doing. So, which one should we cover here? NVDY ETF. I think that's just actually, we won't probably cover this one. NVDY. Oh, yeah. So, this is literally just a covered call ETF on Nvidia. So, you basically buy this to maximize your dividend income. It sells calls on them. And if we go to the dividend yield, 85% dividend yield, notice the dividend went down, but in the long run, like these are not sustainable. It's a slow bleed to your capital, but you buy this to maximize your income because you do get a monthly paying dividend and a really high yield, but you're better off with the S&P 500 or with Nvidia or doing calls yourself. Those more yield max ones are more unsustainable because of the 1% plus expense ratio fees, the return of capital, and the NAV erosion, specifically on those sort of ETFs like the yield max and the title trust ones. Can't touch those. Okay, Dell, let's see. So Dell right here, this is one I wish I bought over Super Microcomputer. I have a Super Microcomputer position. It's not done good. Where are they? Are they down on the day? Here they are. They're up 3% of the day. Yeah, it was Super Microcomputer has done terrible. And again, they just sell a commodity, but I'd rather pick Dell right now. They're actually at a cheaper valuation. So Dell trades at 15 times forward PE. It's a bit of a value play. Like, I don't know if this is actually going to outperform in the long run, but it seems like a good value play. Check this out. If you go to the dividend, you get a 1.5% dividend yield. So not too shabby in terms of the dividend. But the best part is actually the share buybacks. So they're trading at 18 times PE. So they really trade at 18 times net income. Their infrastructure solutions group, which is like installing servers and GPUs into data centers, check out the growth. They grew 44% year over year. After grew 37. So they're on a nice little streak of growth here. How about their other business? Client Solutions Group. Looks like that's a bit slower grower, low single digit one, sometimes negative. But if we go to the net income down here, this is the best part. They made 1.16 billion of net income. After they paid 500 mil of taxes. So they actually retained 1.12 billion of net income. And if we go check how much they're spending on share buybacks, look at the top here. They're spending 1 billion to 2 billion on share buybacks every single quarter. So not only do you get the 1.5% dividend, but they've also bought back, let's see how much of the company. So net income's up 32, but net income per share is up by 38. So they've bought back 6% of the entire company. So they bought back 6% of all the shares plus a 1.5% dividend. Pretty sure they're friendly. What's the low margin business though? And they just like, I don't know about that. I don't know if they have a moat or anything. Yeah. Same with Supermicro, low margin business, commodity, but I like the dividend and the buybacks on that one. Nvidia stock, what up, T? So let's see. Nvidia, what app is this? Hey, what up, Steven? Yeah, hey, if you want to get this app I'm on, it's actually a brokerage where you buy stocks on. It's in the link tree in my bio, that very first link there. It is an affiliate link, full disclosure. So if you go and deposit $100, we'll both get some free stocks. Pretty cool. Another cool thing, let's go check on Nvidia. Nvidia, someone said Nvidia stock. Let's do Nvidia. Nvidia is so big that they also own a bunch of individual companies like CoreWeave, VPLD, ARM, or they own shares in those companies. But let's check out Nvidia right here. They just reported earnings. Their actual earnings were great. They had phenomenal earnings. The forward PE is a 28, if the analysts are right. So the valuation on Nvidia is justified, but the markets had just like a realization of I don't really know. Like, we saw a bit of a slowing growth in like the back end of 2026's numbers, but check this out. This is why I actually like Nvidia, but I wouldn't own them just for me personally, because in the law of large numbers, if you look at the market cap, Nvidia is worth 4.43 trillion. For you to double your money, it has to be worth 8.8 trillion. But I still am a believer that Nvidia is going to keep up and probably outperform the S&P 500 in the long run, even if you buy it right now. Probably. keep up with it. So yeah, if we go right here, main data center play, they have this automotive software that, Lucid and Uber use, PC GPU market share of 24%. But check out the net income. This is what's ridiculous. They made 32 billion of after-tax net income, after they paid $4 billion of taxes. So they made 32 billion of net income. Sales are up 62. What's the net margin? 55% net margin. So if you go spend $100 on an Nvidia chip, they keep $56 of that after paying taxes. So that's ridiculous. The free cash flow is insane. They're investing a lot into the future. Like they took a big stake in Intel, they took a stake in Nokia, they have a big stake in CoreWeave, ARM, APLD, a bunch of companies, and call it a little bubbly because Nvidia is giving money to CoreWeave and APLD and Nebius, just like giving them money, giving them stakes, just for them to go back and buy Nvidia chips with that money. So we're seeing a little bit of a circular kind of thing happening right now. Because also, NVIDIA owns 100 billion of OpenAI. OpenAI owns 10% of AMD. So whenever AMD goes up, NVIDIA indirectly benefits. So actually, I do own AMD. I thought it was an easier double just from the law of large numbers. Again, NVIDIA is worth 4.4 trillion. And AMD is worth 350 billion. So it seemed like I haven't doubled my money, but I'm up 72%. Not too shabby. They're up 5% on the day. But yeah, here's our Weebull portfolio. We have not done too good, but we're up 2.5% on the day. And we have a Robinhood portfolio. We're up 2.5% on the day in this portfolio as well, mainly led by Google, man. Google is at a super new all-time high here. Crazy. So let's look at V. Is it overpriced? What up, Austin? Let's do Visa right here. Then we can get to Uber. Hey, I really like Uber. Actually, you know who owns Visa? If we go to the Nancy Pelosi portfolio, one of the stocks she owns is actually Visa. It's chunk of her portfolio, but this is a phenomenal buy and never sell dividend growth company. Hey, we'll look at Weebull after this. My stock portfolio is in heavy defense stocks after I hit six figures. Oh, hey, that's probably the right move there. So check out Visa right here. You get a 0.72% dividend yield, but notice they raise the dividend every year pretty aggressively, like way faster than inflation. So that's what's pretty cool on Visa. But check out this net income. They're easily making $5 billion of after-tax net income a quarter. Those small little micro credit card transaction fees that are slowly bankrupting us are making Visa a lot of money. So they're making $5 billion of after-tax net income a quarter. What are they doing with all that money? Well, they pay a small dividend. The dividend only costs $1 billion. So they're spending the rest of their money on share buybacks. This is my favorite part about Visa. If you look at the top here, they're plowing $4 billion of net income a quarter on buying back their own shares. And here's what that does for you. The net income actually fell 4.29% year over year. So net income's down 4.29%. But the net income per share, EPS, only fell by 1.1. Again, the net income growth rate and the EPS growth rate should always be the exact same. The only thing that changes this is the share part of the ratio, and they actually bought back their own shares, so the EPS didn't fall as much as the net income, which in thus makes the PE ratio go down, gives you more ownership in the company, makes the cost of dividend go down. So in short, those buybacks force the stock to go up. Kind of cool. How do you see what stocks? Oh yeah, you just go to the Discover tab and you click Insights, and yeah, you can track all like the Super Investors portfolio. Yeah, it's on this brokerage, Moomoo. If you want to get it, it's in the link tree in my bio, very first link there. Yeah, you can see like their exact weightings and their performance and all that. Kind of cool. But if you want to get rich by Asia stock, I don't know what that is. If you got a ticker symbol for me, let me know there and we can check it out. So here's another cool stock that I like. And I've actually been buying the dip on this one here in my Robinhood portfolio. I've been buying it very lightly because its current valuation is still a bit pricey. Based off my a little bit generous expectations, they're trading at 35 times next year's net income. So a bit, not crazy expensive for how growthy this business is. We own 50 shares. I love this company and I'm bullish on them for the long run. I'm a permeable, but I wouldn't have it as a major size position, for now. So check this out right here. According to their analysts, yeah. So remember my forward PE was a 45. Well, Moomoo's or the real analysts have this at 62 times next year's net income. So, reason I'm more bullish on the analyst is because of what I've seen. So Weebull stock, ticker symbol Bull, is literally this brokerage, this app right here, publicly traded. I've been using this brokerage for many, many years, and we're not doing too well. We're only up 10% all time. But what they just added to the app is the reason I'm so bullish. They added in this prediction market stuff, and they added in crypto back. It says new, and the advisor stuff as well. So they added in literally everything that Robinhood has been doing that made Robinhood stock rally up. I regret I've ever sold a Robinhood, and but one of the main reasons Robinhood stock is at an all-time high is because they introduced crypto and advisory and the prediction market stuff. So I think Weebull's going to beat their expectations more so than the analysts. And this quarter was a great example of that. Analysts expected 137. They did 156. The analysts expected 2 cents. They did 7. I think they're going to do 7 again. So Anywho, if we go to their sales right here, the revenue's up 55% year over year. So the growth is back. That's why I like them. They just seem like an interesting growth company. They're just now getting profitable. And I'm a user of their platform. And I'm a shareholder, so I'm totally biased. But I only own 50 shares of them. Looks like they're having a pretty good day. Look at that. They're up 4.28% right now. Yeah, just the market's having a great day. Congrats if you own stocks. You got to be doing pretty well. Or just like the S&P 500. Pretty great day. So let's see here. The trade desk too risky. It's too expensive even after its dip. Hey, what up, Nick? Yo, just saying IDEX hit all-time highs. Oh, heck yeah, dude. I remember looking at them a bunch. I'm so glad you're doing well on them. Nate said COHR. Let's check this one out. Coherent. Then we'll look at the trade desk. What is prediction market? Well, that's just where I don't do this stuff, but this is why I'm also bullish on Weebull. Whenever you go buy and sell a stock on a brokerage, they barely make any money. They're making a fraction of a penny. But whenever you go do this stuff, this is the prediction market. So if you can literally bet on this is so stupid. But I guess, but whenever people do this, will it rain in Miami this month above 2 inches? Whenever you go do something weird like that, they make a juice of a commission, a juice of a margin. And in Weebull, this brokerage right here just got into that. And the people who use Weebull are probably the kind of people who will do this kind of stuff. So, hey, will there be an inch of rate tomorrow? Who knows? So here's Coherent. This is a $24 billion company. They're trading at 41 times next year's net income, but they're not profitable yet. Let's go see if we can figure out what they do. So they're a data center and communications. That sounds like an industry you want to be in right now. Industrial. Let's go see. Is there any AI breakdown of their news? That would be kind of fun. Nope. Okay. So let's just go down here and see what they reported. So the orange line's what the analysts expect. They beat on revenue. They beat on EPS by a big margin, and they beat on EBITDA too. So it really was a triple beat. Was that real though? Did they actually make 225? So no, they didn't actually make 225 million net income, but they did really make 150 million in net income. So yeah, ignore the net income right here. They had a little one-time adjustment. Like last quarter, they didn't actually lose net income. Last quarter, the core business actually made 120 million of after-tax net income. So actually, you honestly do 600 mil of, they're going to be making. So 24 divided by 0.6. Let's see. This is my this isn't even like crazy multiple. This is like, so they're okay. Okay. Same as analysts. I have this at 40 times next year's net income. So analysts have it at 41. So hey, actually I like the growth there. Good profit. It looks like margin expansions. Would you buy Uber here? I would. I would nibble on it. If I wanted Uber as 5% of my position, I'd make it probably 1% today. I went at full size. I'd start the dollar cost average today at their current price. So yeah. TTD. I want to pull up the trade desk here. It looks like my Wi-Fi's been buggy all day because there's like a construction people messing up Ethernet wires. But yeah, the trade desk, look at this. So even after this, crazy dip that it's had, they're still pretty expensive. They trade at 44 times net income. And one of the main reasons they're losing their high multiple, again, it's okay to have a high multiple as long as you're high growth, and they do have some good growth, but they have been missing on some of their margins and growth expectations. They're also losing a lot of their main customers. Like if you didn't know, one of their main customers used to be Netflix. Netflix, with their ad tier subscription, used to use the trade desk to find advertisers. Now Netflix actually switched over to Amazon and Roku. So one of their main competitions now are that Amazon and Roku. So I'd rather own Amazon stock. But yeah, they're a CTV advertising company. And their results were great this quarter. Let's see what it was. Or I don't remember. Revenue growth is fueled by Kokai platform and CTV advertising expansion, 18% year-over-year increase. Profitability improved with 43% adjusted EBITDA margin. Customer retention stayed above 95%. So that's pretty good. Yeah, if we go to their net income, they make good net income. Easily. Well, if you kind of average it out here, yeah, if we average it out, they're making over 100 million of after-tax net income a quarter. And that's what's still the value here. They're still making, 100 million a quarter. What's the sales growth? Yeah, revenue's up 17, after grew 27, after grew 25. So it's a nice advertising play, but it might be a slight bit too expensive even still. Well, actually, let's see. Forward PE is a 38. That's not nuts. I mean, honestly, Meta is dog cheap compared to this. If you want, but I think there could be. I wouldn't full size position the trade desk yet, but they're certainly interesting. I put them on the watches maybe as an advertising play. I do like Meta here a lot more. And Amazon probably. Amazon and Meta are both ironically cheaper than that company. But I guess Amazon's not a pure advertising play. Meta kind of is. Hey, Fano said SK stock. Hey, give me the ticker symbol. I have no clue what that is. Yeah, if you got a stock you want me to look at, let me know what the ticker symbol. We'll check it out there. So let's check out Innodata. Innodata actually just reported earnings, and we can look at Cormedics too. They reported earnings like last week, and basically there was a $25 million expansion expectation from federal government contracts. I don't know if, okay, yeah. Digital data solutions segment grew 23% year over year. Operating cash flow increased 65%. Free cash flow rose 46%. Profitability was pressured by AI infrastructure R&D investments, causing net margins. Oh yeah, so if we go to the revenue right here, actually check this out. These are what the analyst expected, the orange line right here. This is why I like the company. Every quarter they beat on revenue. They beat massively on net income this quarter and every quarter, and on EBITDA as well. So it was a triple beat quarter. I just like how growthy they are. Five of the Mag 7 are customers. And here's their net income. It was slightly impacted by a one-time adjustment they had this quarter. So the core business actually did grow year over year, the profits, but there was the one-time adjustment that quarter. But anyway, I really like Innodata. They make net income every quarter. They're making 10 million net income a quarter, and the whole company's worth 1.8 billion. It's still expensive here. It's actually pretty expensive right now, right here, and I'm up 50% on my shares. That's why I'm certainly not selling out of my position there, but I think it's still too expensive to buy here. And as much as I love the company, I would not make this a major size position. Like, even if it fell, like I'm up 70%, let's say it falls 70%, you still wouldn't want to have this as a super major size position in your portfolio, a small little like fun money investment. And I have a bunch of those. Like if you head over here to my Weebull portfolio, like Toast, Supermicro, PSIX, especially Rumble, Clear Secure. I love these names. I like their numbers and I want to own them, but not as a major size position. I just put a couple hundred in them. How does Meta make money? Yeah, Facebook ads, Instagram ads, they print money on that. That's like 99% of the revenue. I think, or it's like 95% of the revenue. It's pretty crazy. So use Weebull. Hey, I don't know. Hey, give me a ticker symbol if you have a stock you're gonna look at. You're just like saying a country or something. I don't know what you're talking about there. Okay, someone said the ticker is 000600. You know what? We'll see if we can find it. I doubt it, but maybe we can. Yeah, so I don't know. We tried to find it. I looked for you, but unfortunately that stock we just can't view on my exchange. All right, let's look at PayPal here. Let's do PayPal right here. So PayPal, this one unfortunately has not done too well. It's sadly the same price that it was in 2017. So the stock's been flat for 8 years. Let's see what the earnings were. Will they break it down? So revenue growth was driven by PayPal and Venmo products, offsetting declines in Braintree transactions, with total payment volume increasing 8%. Earnings per share rose 31%, aided by transaction margin growth and buybacks. Strategic initiatives included launching a buy now, pay later service in new markets and forming AI-driven shopping. Okay, well, their P ratio might be kind of fair. That's the thing. Like if we go to PayPal right here and we zoom out from like 2021, like this massive decline that it has, it's sadly, it might be like, it's slightly undervalued, but a 14, 15 PE is like the max PayPal should be, maybe. I don't know. But let's see the revenue. For like historically, this has been a slow grower. Like, this quarter was good, 7%, but 5% growth, 1%, 4%, their sales, the lifeblood of the company. But here's the best part about PayPal and why I like them. They print easily over $1 billion of after-tax net income a quarter. That's after they paid $350 million of taxes. So they're easily making $1.2 billion net income a quarter. What are they doing with all that net income? Well, if you look at the top, they spend it all literally on share buybacks. They're spending more than their net income. Actually, they're spending $1.5 billion. So they actually have been paying or buying back more stock than they've been making in net income. So they've been buying back their own shares with some sort from a cash pile of some sort. But anyway, PayPal, those share buybacks, here's what that does for you. The net income is up by 23, but the net income per share is up by 32. They've bought back so many shares. And they now pay a dividend. You get a 0.9% dividend on PayPal now. So I really wish instead of them paying doing all these buybacks and paying a dividend now, like I wish they could have like bought a company or something, or I don't know. Some like they own Honey and Venmo, like some sort of new acquisition like that. But it looks like they are investing back into their own business. So, hey, CRMD. This is another one that I love, but I wouldn't have as a major size position. Then we'll look at Hilton. What up, Gary? And we'll look at Novo Nordisk. I'm so sad about Novo Nordisk. They had disappointing results this morning. I think they're down like 9%. But here's CorMedix right here. This is one of my favorite healthcare names to not have as a major size position. If I actually own them in my Roth IRA. Full disclosure, if you head over here, it's one of our, so we own 75 shares of CRMD and it's worth $750. I legit never in my, well, maybe one day if it tanks, but I never ever planned in my life to really have this over 100 shares. As much as I'm more bullish on the CorMedix than probably anyone here. I think this is a 3x easy, but as much as I believe that and want to, I can't have this as a major size position at $705. And now let me give you my bull pitch for this stock. I freaking love this company. The whole company is worth $780 million. I don't normally talk about these kind of stocks, only worth $780 million, but they trade at 3 times next year's net income. They currently trade at 4.5 times net income. They trade at 3.3 times next year's net income. Like there's literally 30% net income EPS growth that's expected, but the stock just doesn't care, apparently. Their main product, DefenCath, has just seen monstrous growth. They created this in 2024 when it got FDA approval. Sales were $800K. Now it's $88 million. That's their highest margin product. They have 50% net margins on that. And then they just acquired Malenta Therapeutics to add more products to their portfolio because that used to be the only thing they sell. But yeah, big beat on revenue this quarter. They expected 86. They reported 105. That's not just that's like a huge beat. Everything was insane. They made basically 50 mil in net income this quarter. The sales were 104 mil. So I really like CorMedix. Just a really cheap company. They also have a big stake in TLPH. Actually, they bought shares of TL. Oh, wow, they're up 9% on the day. CorMedix bought, I think it was 10 million. They bought 10 million of this stock at 50 cents. So I guess now it's worth over 30 million for them, for their market cap. I don't know. If CorMedix bought this company, they have exclusive rights to buy this company if their results are successful. Because this is a startup right now that they have no sales of their product. But if their test results are successful and they dropped them a bit ago for their next phase, they'll buy that whole company. Anyway, there's some interesting catalysts on that company. Hey, what up, Lulu? Good to see you, homie. Yeah, sorry, we'll try. I'm so behind here. Let me get to HLT. This is Hilton Worldwide. This is my favorite hotel stock by far, by a long shot. The best one, best stock, of course. They have the best buybacks of any company I've like nearly ever seen. If we go to the net income right here, and they're easily making $400 to $500 million net income a quarter. So they made $420 million net income this quarter after they paid $250 million of taxes. So they really retained $420 million of net income. Well, check this out. This company pays a dividend. The dividend only cost $35 million. That is so little. And why did the cost of the dividend go down from 37 to 35? This is the best part about Hilton. I kid you not, no matter what, I love this stock. They buy back 4 to 5% of all the shares that exist every single year, no matter what. Like just all for eternity. That's the best part of this. I mean, the buybacks are insane on this company. It's the main reason I love them. The net income's up 22 and the EPS is up by 28. Or 29 basically. They're also technically like a royalty company where the people using their Hilton name and Hilton Worldwide brand, they manage it and collect a royalty from all the stores. So it's not just exactly this like hotel company. I used to own this one and I regret selling it, but I switched it out for a better stock at the time. But I might look back into getting into this one. They are my favorite hotel by far. So Novo Nordisk right here, they had some disappointing results of their Alzheimer's prescription, I believe. So yeah, check this out up here. They're only down 6% right now, but Novo Nordisk announced Evoke phase 3 trials did not demonstrate statistically significant reduction in Alzheimer's disease progression. So that's not great, bad results. So dang, what's the multiple on this company? So they trade at 12.5 times net income. The sad part is that might be fair for Novo Nordisk because they also lose their exclusivity for Ozempic in a couple years. So that's where they were trying to buy Metsera, but they got outbid by Pfizer. Pfizer's like, no, I'm going to buy them instead. Oh, first off, this is I think they're headquartered in Netherlands, but we'll convert the currency to USD just to get a better understanding. Yeah, so if we look at the sales, the revenue, it grew 10%. The revenue grew 10%. But the net income actually fell by 22. And that's not some one-time adjustment either. The core business really did. The net income really fell 22, which means the net margin collapsed from 38 to 26. It was a triple miss quarter as well. They missed on revenue, missed on net income. So Actually, I don't know, but the valuation is so cheap though. It might, like that's the thing. It might all be priced in now. The PE ratio or the forward PE is 11.6. They're trading at 11.6 times PE. Maybe with no growth and no EPS growth, that's a fair multiple. But and plus the patent expiration, and plus now their Alzheimer's prescription didn't work. It's a bit of a juggle there. Hey, shout out to the homie Brian Paul. Yo, my bad when I refreshed the stream. My stream the other day wasn't working and I wasn't able to see anyone's comments on the YouTube stream, but I felt so bad. But here's MUSA. This is one of my favorite stocks to buy the dip on. Hey, what up? Good time. He said, hit the like. Hey, thanks for that. Hey, what up, Johnny? Bubba said SoFi. We'll try and get to all these. And Paul, Rich Tech Robotics. Yeah, hey, Paul. We'll look at those robotics names too. So here's Murphy USA Oil. I love this stock. It's my favorite way to get exposure to oil. And I've been just dollar cost averaging into this name. So I love this one specifically. Like there's a bunch of oil and gas stocks out there. I like this one specifically because they don't suffocate themselves with a high dividend payout ratio. They have a 7% payout ratio and only a 0.5% yield. But the best part is the share buybacks they're doing. They legit have bought back 39% of all the shares that exist just since 2019. So yeah, they've been one of the better performing oil and gas stocks since 2019. So that's what I just think they're going to be the growthiest oil and gas name. So that's why I picked them. Hey, Looney, remind me to get to MasterCard. We just looked at Visa. Okay. Okay, let's look at SoFi right here because we haven't looked at them today. And we do own SoFi in our Weebull portfolio. So if we go to our Weebull portfolio right here, how's the stocks doing today? Yeah, wow. SoFi is up 7.5. A lot of the fintechs are because Futu's up 5.7. Robin is up 6.9. Dave is up 5.4. These are all fintechs. How about Toast? Is Toast up? Yeah, Toast is getting toasted just because of all the restaurants right now. This is a restaurant, basically point of sales payment provider, a software company. Their revenue, all the revenue comes from restaurants, and restaurants aren't doing well right now. But let's get to SoFi right here. I do own this company. They absolutely deserve their high multiple, 48 PE. This is the kind of company that deserves a high multiple. I wouldn't, if you didn't own SoFi before today and wanted to get into this one, I would not buy it with like a lot of money and real money today. Like maybe slightly nibble, but not after the 7.5%. I wouldn't buy this one significantly yet, but here, this is the kind of company that deserves this high multiple and is the kind of stock that's just going to continue to go higher and higher in the long run. If we go to their financial services revenue specifically, this is the kind of growth that impresses me and justifies that high multiple. The revenue's up 76, after grew 101, after grew 140, after grew 290. They're on an absolute streak of growth, and that's what impresses me. And no analyst expected that, and we can see the analyst expectations down here. That's the orange line. Every quarter they beat on revenue, beat on net income, beat on EBITDA. So that's why I just think people are taking SoFi serious, making over 100 mil in net income, not too shabby. So could you look at SCRV and Rich Tech Robotics? So unfortunately, both of those are complete garbage. And I've looked at all the robotics names out there, but these two are just propped up on momentum. There's no if I want to buy a robotics company, I want to buy one with real fundamentals. Rich Tech Robotics and Serve Robotics don't check the box for me. And I'll share with you one after this that does check the box for me. So here's Rich Tech Robotics, some micro cap. If we go to their sales, the revenue, the lifeblood of the company, the revenue is literally $1 million. That revenue is down 19% year over year. They're losing net income every quarter. They're diluting the life out of you. But it's smart for them to dilute you when they did at the price of like $6. But yeah, they have no IP, no patents on Rich Tech Robotics, but here's my favorite robotics play. It's actually SYM Symbiotic. They have over 1,500 registered IP and patents. It's a warehouse robotics company. And hey, if you like, I like Rich Tech Robotics as they're on the dip. This one's also somewhat on a dip. So also Symbiotic, they help out Walmart with their warehouse robotics, and Walmart loved them so much that Walmart decided to buy a stake. They own 13.5% of all the shares. They have over 1,500 registered IP and patents, and if we go to the revenue, again, Rich Tech Robotics had $1 million of revenue. We'll check out this one. The revenue is $590 million, up 25%. After grew 50%, after grew 77%, after grew 33%. Like they're on a unit, like an absolute streak of growth. That's what's cool about Symbiotic. Hopefully that was helpful. Again, my favorite robotics stock of all time would be Amazon. Obviously, Amazon's not a pure just robotics play, but they are really the best. And look at this article today. Here's like a great example of that. Amazon cuts thousands of engineers as it rolls out AI tools to replace them, aka robots. What they've been doing is Amazon's been calling them cobots to get off regulations like radar. They've been calling them cobots. They're like, no, they're not replacing people. They're working with them. But they're like, no, we're not firing people. They're just, we're just not going to hire 500,000 future jobs that we would have. We're not firing people. Amazon is the real best robotics play and the best company to benefit from robotics. Even if Amazon doesn't do the robotics themselves, they're the most to benefit from, okay, let's keep going here. When are you going to look into Zeta? I love Zeta. Actually really cool. I just sold my race stock, might come back to it later if it goes down. Hey, Zero, I get that, man. You know, sometimes what is smart to do, certainly on red days, like what you can do is you can trim out some of your smaller size positions and allocate them to more higher quality positions. But yeah, race is one that I'm a bull. Oh, look at this. This app is telling me that there is a bearish flag. So from a technical point of view, maybe the stock's gonna go lower, but this is one I'm bullish on in the long run. They're still pretty expensive, 30, well, not crazy, 35 times next year's net income. That's actually pretty fair for a Ferrari, I think. And that's, again, in this market, in this environment, with how things are, you can't, like, if you want to make Ferrari a big position, you can't start it out as a big size position at this price and stuff. But I love this one. You get a 1% dividend, over 1% in buybacks. They have a huge backlog of orders. They collect sponsorship revenue. That's all 100% margins. Like, this isn't like, what other car company has 22%, 25% net margins? Not Tesla, not Ford. So anyway, race is cool. Race it, if out of all the car stocks out there, if their input costs get hurt, their price of aluminum goes up or whatever, and they have to raise the prices on their car, they can do that the most before anyone else. The people who are buying Ferraris don't really care if the cost goes up another 3,000 or whatever. So, Dogecoin is now in Wall Street. What up, Readback? How's it going? Sorry if I miss any stocks here. Let me know if you got any. MD, Mind Medicine, is $1.1 billion company. So they're worth $1.1 billion. They're the same prices they were back in 2022. So not doing too great, but let's go look at their numbers. So it's a revenueless startup. So if we go to their revenue right here, it says zero because they've just never sold anything, not a product or a service. What is it they do? So yeah, they're a biotech company, clinical stage. So again, I just can't, me personally, I would never buy these kind of stocks. Look at this. The whole company's worth $1 billion. They have no revenue. They lost 60 mil, 40 mil, 100 mil. Like, that's over 100 mil in net income easily, which is over 10% of the market cap, and is leveraging up their balance sheet. Look at this a year ago. The liabilities used to be only 18% of the assets. Since they've lost all this net income, their assets are slowly going down and the liabilities are creeping up, which is leveraging up now 44%. Wouldn't want to own that one, but if they have some successful results on clinical stage data, that same day they'll probably rock it up, but I don't know. Papa said mushroom company, Mind Medicine. Really? Treat brain and health disorders. Pretty cool. Okay. AbbVie is down a little bit. Yeah, probably just, healthcare and stuff. Whenever tech is really green, healthcare kind of doesn't do as well. Maybe it's just from Novo Nordisk. Novo Nordisk really led a lot of the red in healthcare today. But anyway, here's AbbVie right here. This is a phenomenal, never sell stock. Actually, hold on. Let me go ahead and put this on the safe never sell watch list, because AbbVie is a safe never sell, not financial advice, even at their current valuation, even at their current price. 26 times next year's net income is so fair for this kind of stock. It's one of the few companies that have like a 3% dividend, and it's totally safe. Like, there's even room to raise it. So check this out down here. They own Skyrizi. This is their most popular prescription. Check out the growth. The revenue's up 46, after grew 50, after grew 52, after grew 85, after grew 104. Literally unbelievable new record. That's what you want to see for a growth company. Sales of this Skyrizi was 350 million for the full year 2019. Now it's like a whole game changer. It's 11 billion of annual revenue, and that's just one little prescription. Check out Rinvoq. Insane growth on this one as well. Up 35 after 45, 50 after 55, after 83. Insane growth on this one as well. There's it on an annual basis as well. In 2019, it was 47 million. Now it's 6 billion. They're kind of like a mini Eli Lilly, but they're not that many. They're actually huge. So their Botox business is doing really good as well. So anywho, you don't focus on the net income. They have a lot of these one-time adjustments because they had this schizophrenia prescription that I think caused death, or I don't know. Something happened this quarter. They didn't actually lose that money, but anyway, I love AbbVie, and they're really making around $4 billion in net income a quarter, and we can see the EPS expectations. There's a lot of AbbVie's a never sell. Yeah, hey, there, no problem there, Paul. What do you think about uranium in general? Yeah, so look at my favorite. There's the ticker symbol URA, the Global X Uranium ETF. My favorite uranium stock of all time would be Cameco, ticker symbol CCO, the safest one and best one. My second favorite would actually be down here, ticker symbol LEU. They've also been one of the better performing ones because this one actually makes really consistent net income. Well, they didn't this quarter, but they're actually making net income every quarter. The only one that's also like this is Cameco. All the other ones are still struggling with net income positivity, but yeah, they sell that yellow cake uranium for nuclear reactors. And that's why uranium's been booming, because there's so much stimulus around nuclear reactors, and nuclear reactors need uranium. And honestly, best nuclear reactor play is CEG. The stock literally owns 33% of all the US's nuclear reactors. And hey, shout out to Papa Dan. No way there. Thanks for those gifts. I really appreciate that. The Let Them Cook. No way. Happy Monday. What app is it you're using? Or hey, what up, Minder? I'm actually not sure what app you're talking about. I got all three of these apps here. If you're looking for a stock to buy or app to buy stocks on, these are all brokerages, so they're all in the link tree in my bio. This one I'm on right here, I think, is the very first link in the link tree in my bio. This is my favorite one. It's free, costs nothing, no fee, hidden fees or anything. So let's look at yes, nuclear plants, I think will blow up. Yeah, me too. Yeah, CEG, Looney, that's the best one by far. So yeah, this company owns 30% of all the nuclear reactors. They're acquiring Calpine, which is going to literally add every quarter for the rest of their life, 50 cents every quarter to the EPS for the rest of the time, because it's $2 billion accretive to the free cash flow and $2 to the EPS. So the net income is supposed to rocket up, and that Calpine acquisition closes this quarter in Q4 this year. So anyway, they also have a great dividend, 0.4% dividend, very low payout ratio, is the best nuclear stock out there. They do share buybacks, they do dividends, they do M&A, they do crazy deals with Microsoft, and Meta. They have a deal exclusively, they have this one nuclear reactor that's going to power just one Microsoft data center. They have one for Meta too. They're cool. Hey, Monkey said what happened to, or Monkey D. Luffy said what happened to Novo Nordisk. Yeah, they had bad results of their Alzheimer's prescription today, and they got tanked. So someone said Coca-Cola Consolidated. So yeah, well, yeah, hey, if you want to get this app again, it's a broker called Moomoo. It's in the link tree in my bio, very first link there. Of course, they ask for a bunch of information. You'll ask for okay, so anyway, actually, here's the thing. What was that we were going to look at? Coca-Cola Consolidated. So not a lot of people know the normal Coca-Cola company, you know, the one Buffett owns, ticker symbol KO. Oh, wow. This, they're saying that there is, what is this? A bullish continuation triangle. The rise probability is an 88% chance, but you get a 2.8% dividend on Coca-Cola. I love them, but I love even more than that is the Coca-Cola Consolidated company. This is the bottler of Coca-Cola. They have massively outperformed. They've been one of the best performing stocks in history. This is insane. If you're wondering why did they recently gap up on this day right here, I've never seen this before. At $127 a share, at $127 a share, you ready for this? They bought back 22% of all the shares that exist at $27 a share. I've never seen a company do that before. So that was insane. They bought back all 22% of all the shares, which is literally in the future going to make their EPS go up by 22%, make the dividend cost 22% less. But besides that fact, this company has had just massive pricing power. If we go to their annual net income right here, this is why they're up so much. Their margin expansion has been crazy. Same with the operating profit here. This is more of a smoother line, but the profits that this company has been milking is insane. So I like them. I don't know about the current valuation. I mean, it's honestly a 23 PE that's going to fall by 22%. It should be interesting. Bottling big winner this year. Yeah, apparently, not just them. Actually, they bottle for Dr. Pepper, Monster, and Coca-Cola. But look at Monster Beverage, for example. Monster Beverage, all-time high literally today. Who knew? This is another one that does massive share buybacks. They took on $1 billion of debt a while back just to buy back their own stock, and it's actually worked out for them quite well. So anyway, Monster's really cool as well. Huge PE for what it is. Wait, which stock right there? Coca-Cola Consolidated, 23. Yeah, historically it trades around a 17. Yeah, it's had a massive little uptrend. So let's see here. What do you think of SPGI? That is or S&P Global, your credit rating company. They have a shared oligopoly with Moody's. for credit rating bonds and stuff. But let's actually go see what the earnings. Do they break down the earnings for us? So the ratings segment increased 12%, driven by higher transaction and non-transaction activity. Market intelligence revenue grew 6%. Indices and mobility saw revenue increases of 11%. So let's see here. What the multiple? 35 PE. That's actually what is historical. It's a 40 PE. So yeah, the ratings business is their number one business. I like how diversified that it is. They have this market intelligence business, which this brokerage I'm on, Moomoo, pays S&P Global for the data. Check this out right here. If we go down to the analyst right here, if you've ever noticed, you see right under EPS, it says data from S&P Global. Moomoo pays S&P Global for that data, which is kind of cool. And that's how we also get a lot of this other cool data. But yeah, S&P Global makes a lot of net income, legit easily over $1 billion of net income every single quarter. Let's see how much the dividend costs. So they're making easily like $1.1 billion net income a quarter. The dividend only costs $290 million. So very safe dividend. The cost of dividend is actually going down. Why is it going down? Because of the share buybacks. Wow. 600 mil to $1 billion on buybacks every quarter. So shareholder friendly. Net income's up 20%, but the net income per share is up by 24. Well, actually, it was up by 20.8. So they bought back 3.2% of all the shares after giving you a 0.8% dividend yield. Pretty interesting. I do like S&P Global. That's a good never sell stock, I think. Can we do? Yeah. Hey, we'll do Bull. Give me like a couple minutes here. I remember. Sorry, Johnny. I saw the first time you said that we had just looked at Bull. Here, I'll go over it again. I got you. Let's check out Weebull stock right here. So Weebull is this brokerage right here, publicly traded. So I've been using Weebull for many years, and my main bull case is the fact that they just added in this prediction market stuff in the crypto markets and the advisory shares, cash management. Like they adding in all these new things that you can do on Weebull that you couldn't do before today. It was right around their IPO time. We're literally right around the exact day they IPO'd is when they introduced the prediction market crypto back to the app. And that's why I'm more bullish than the analysts are. If we go to the analyst PE, it's still expensive, still super expensive. That's why I don't have it as a major size position yet. It's still a little like it's at a fair price right now. The analysts have it at 62 times next year's net income. I have it around like a 35 to 38 times next year's net income. So I'm a little more bullish than the analysts just from that prediction mark crypto stuff, because that's where they make a juice of a commission. So that's kind of my bull case for Bull. And if we go to the growth, it's already been pretty good. If we go to the sales right here, the revenue's up 55% year over year. So that's great. Last quarter's up 46. So it was best 6 months have had a lot of growth because that's when they started the crypto. Cool. So, and I'll show you my position, and then we are actually down on them. We do own Weebull actually in our Robinhood portfolio. We also own Robinhood stock and Moomoo. But yeah, we got 50 shares of Weebull down here. Did I see Google at an all-time high? There's no way. Dude, Google's nearly at 320. Oh my goodness, we're almost up 100% on them. So Meta's having a great day. Meta's up 3.5. CEG is up 4.5. Looks like defensive McDonald's is down, and interest rate sensitive Carlisle is down too. Yeah, we saw like the REITs are down too a little bit today. But oh well, we're overall a great day. I'm happy. Yeah, Comfort Systems is doing great. In this portfolio, we're up over $1,000. So a great improve from last week. All right, let's look at some more stocks here. What about Etsy? Let's look at Etsy. All right. Or actually, I'm missing out. Or I missed one. Kodiak AI. Hey, if you have a stock you've been looking at, give me the ticker symbol and I'll actually check it out for you. So let's look at Etsy. This is like the most discretionary of all discretionary stocks right here. So like you buy a bunch of gifts and stuff for people on there. Actually, maybe we'll probably do good around Christmas time. So let's see right here. Oh, watch out for the... Ooh, hey, watch out for the people in chat there. By the way, I sell nothing. I have no course book, WhatsApp, Telegram. I'll never follow you, DM me. Watch out for the scammers in chat there. Okay, so let's see. Etsy. Well, actually, I didn't know that only 52% of the revenue comes from the US. Well, I just thought it was more than that. But let's check out the revenue. So it looks like the growth is gone. No way. Growth is gone on Etsy. Only 2%, 4.81. So that might explain why the stock, looks like this, because the growth rate is gone or doesn't really beat inflation. What about net income though? So sales are up 2%, doesn't beat inflation, but the net income, wait, is that real? Yeah, they really did. They actually made 75 mil in net income this quarter, 30 mil last quarter. The numbers are a little choppy, but it looks like they are making net income every quarter. Looks like they have a bit of liabilities. So forward PE is an 18. Hey, actually, that's not too shabby. I also like eBay. For some reason, I like eBay. 18 PE, that's maybe a little too high for eBay, but they actually have a dividend now, like a 1.4% dividend yield, kind of like a PayPal. And they make good net income. They're actually making like 500 to 600 million net income a quarter. Also kind of lost their growth. XBD said Nebius. You know who owns Nebius? That's actually a stock owned by Nvidia. If we go to the Nvidia portfolio right here, they own CoreWeave, APLD, and they also own Nebius right here. These are all just like companies that do cloud deals that just own a bunch of GPUs in a data center. So let's see what the news is. Nebius reports 55% growth. They have like a really big deal. Well, let's go look at this. Yeah, they had a $17 billion deal with Microsoft, which is crazy. But my favorite part about Nebius, just because Nvidia owns a stock doesn't mean you should, always go do your own research on them. I really like their top line growth here. The revenue is up 355% year over year, literally from 30 mil to 150 mil. And out of that, they still lost 130 mil in net income. So they're still losing 100 mil plus in net income a quarter. But it looks like in 2 quarters, the losses are supposed to narrow to 66 million. And look at the revenue. It's supposed to go from 150. Again, this was a record already. The sales this quarter were 146, a record. It's supposed to go from 146 to 469 in just 2 quarters. So there's a lot of top line growth. And I guess the losses are supposed to narrow a little bit, but there's still, in the long run, a bit of the bag holders. Not one I'd own with a lot of money, but it's kind of like it's a good swing trade. It's a medium short term swing trade. I wouldn't just buy and hold shares of that one forever, actually, now that I really think about it more, because they're basically buying all the GPUs now for a high price. Okay, SBAC. What's this one? Oracle. Hey, remind me to look at Oracle and MST. Hey, that's a trash one. MSTY. That's some covered call junk. But we'll check them out though. Here's SBA Communications. It's a $20 billion company. I think this is like the competitor to AMT. They're a cell tower REIT. What's the dividend on this one? The yield to 2.23% dividend yield, not too shabby. But this is like domestic site leasing, international site leasing. Okay, and site development. Okay, let's check this out right here. So revenue's up 9.7, and the net, actually, you really don't look at the net income. You really look at the cash from operations. So they made 318 mil this quarter, which is the dividend cost. And the dividend cost 119, so they can't afford the dividend. Is this one a REIT? Let me double verify. Yeah, it is a REIT. So whenever you receive these dividends, they're actually taxed as short-term capital gains and not long-term capital gains like your average stock. But they really do have a safe 2.23% dividend, but it looks like the stock has been struggling. Same price that it was in 2019. What's the growth rate of the revenue? So I mean that is good, 9.7. What about annual? I mean it's flat from 2022, but it's not too bad. I don't know. I'm probably not one I'd own. I've looked at them before. I actually chose. I sold out of them, but I chose American Tower Corp over them, ticker symbol AMT. We can kind of see how they also nearly have like a somewhat identical chart here. They're also an international play. That's what I love about them. 62% of the revenue comes to the US. Then there are all these like upcoming countries that need cell towers, So AMT is cool. So yeah, MSTY, this one is a covered call ETF. You buy this to maximize your income. JJ said, hey, I didn't mean to bag on MSTY, but he says I'm up on MicroStrategy. The stock is at an all-time hit an all-time low on Friday. But yeah, these are just sadly a slow bleed of your capital just from math, especially the yield max ones, because they have this has a 1% expense ratio. This doesn't keep up with the S&P 500's 8% CAGR, so you already lose by 1/8. You also get ROC, return of capital, which gives you more of your money back instantly, which plummets the future dividend income you get, and it makes the stock price go down because there's an NAV erosion. So I've done the math on these. It's really good to maximize your income, but the dividend income goes down by double digits every year. It's not something you really trust as a sustainable kind of income asset. Like, dang, it's $7 right now. I just don't love those, sadly, but they have good dividends. But that doesn't mean it's good. Forget the dividends. You always focus on total return. So actually, here's a good thing to do. So someone said he was up on your position. He might be right. He might be up on his position. Like if you you have to, after factoring how much you've lost in stock price appreciation, you have to add back the dividends. But after you add back the dividends, you have to also add the fees you pay and the higher tax bracket, because covered call ETFs actually pay non-qualified dividends. Actually, they're not dividends. Covered call ETFs, what you receive aren't actually called dividends by tax law. They're actually distributions. They're not dividends. They're called distributions. So because it's income from options. Okay, APLD. Let's do this one right here. This is another one that actually Nvidia owns a lot of this stock right here. $6.5 billion company. They're a cloud data center hosting company. 60% of the revenue is data center hosting, high performance hosting business. They used to be like a Bitcoin mining company. APLD completes 100 megawatt building at Polaris Forge 1A Capital. Okay. Well, anyway, let's go look at this right here. So this is why the stock gapped up on earnings day, but they've been down since. But analysts expected 45 mil. They reported 65 mil. Analysts expected them to lose 13 cents. They only lost 7 cents. So I guess that was the good news on the most recent quarter. But I don't know. It's still, really expensive because they're not planning on making any net income for a while. But I don't know. They're just another, it's like a Bitcoin or Nvidia proxy kind of. Let's see. Roblox. Should we look at Roblox right here? So Roblox, that's actually in the Cathie Wood portfolio. And then we can look at SE and Enphase and Netflix. Netflix is starting to look very attractive. Actually, that's in the Nancy Pelosi portfolio as well. Wait, here's Roblox, and here's Cathie Wood's portfolio. So Roblox, I don't like this one yet. Like, there's some really, really good news. Like insanely good news, but there's also some bad news. Check this out. If we go, this is a cool metric we get. Their daily active users. If we go to their daily active users, it's 151 million right now, when this exact same time last year was 88 million. So I don't know what happened like between this quarter and last quarter specifically, but their daily active users, hard users to get, went up by like literally 35% quarter over quarter. I don't know what caused that. Let's hope it's not AI bots or something, but the growth is there. The revenue growth was very nice, but this is the part that scares me, and I wouldn't have Roblox as a meaningful size position, because if you go to their net income, they're sadly burning through 100 or 200